Let's switch gears now, sort of talking from, I don't know what we call it, new economy to old economy. Energy has been one of the hottest sectors of the market lately, but my next guess is the stocks are still trading at a 30–40% discount. Does that spell opportunity or caution? Joining me is David Wagner. He's a portfolio manager at Aptus Capital Advisors. David, it's great to have you. And it's kind of a letdown having to talk about, old world stuff now. But people have called this the revenge of the old economy. And it's obvious that underinvestment is causing these price spikes. I guess my question to you is, do I really want to buy equities in an area that has failed to deliver returns for investors over the past 10 years while Tesla is up like 20,000% or something?
That's definitely a hot question right now. And Kelly, thanks so much for having me back on the show. I heard you say that you were a 12 out of 10 excited for this show at this hour. And of course, definitely not for me. Phil, Dan, I are great conversation pieces. But yeah, energy, definitely feels kind of old age here. Jed Clampett, probably from the Beverly Hillbillies, is definitely a happy camper today, loving on that black gold Texas tea. But, from a serious perspective, energy continues to mark all the three boxes that I look for in an investment. Technicals are definitely there. I believe the macros are there. And then from a fundamental side, well, the fundamentals from a valuation perspective have definitely been there for the last 8 years. You definitely haven't had the returns like you've had in a Tesla. And I think most traders right here would call us kind of late to the trade here, that a lot of the easy money has been made.
Right.
But I don't agree at all. I think they're wrong. I think short term, yeah, the sector looks a little bit overbought right now. It looks like it could possibly take a little bit of a pause, but longer term, we were very bullish on the entire sector, specifically E&P. So why are we long-term bullish? Well, right now, these companies are being priced at a 40% discount to the forward 12-month strip pricing, which is like $74, give or take,
right,
a few dollars in 2022, meaning that they're pricing oil as if it's $45. And,
right,
I don't think any of us here really on the show would expect oil to be close to $45 moving forward, especially when you're considering the environment right now where you're having substantial shortages as well as prolonged underinvestment in the space, regarding new projects and development. So we're big on energy right now, so let's go Texas tea.
Well, and maybe the way to sort of flip that around is that from your point of view, that means the stocks are going to catch up. But there's plenty of investors and capital that's saying they're not sticking around to find out. Pioneer is a name that you like, and even Scott Sheffield has said he's not going to drill if the oil price is high. He's only going to drill if his stock price doubles. So even to him, it's an open question if they're going to enjoy that kind of performance. So you'd stick with Pioneer here. You like Chemed. Anywhere else that you would tell our investors if they want this exposure?
No, we love small caps. We love mid caps. We love quality. And Pioneer Natural Resources definitely kind of fits that bill. It's kind of more of a mid cap, smaller, large cap, but definitely on the highest echelon of quality within energy. We continue to view their deep inventory of high quality drilling locations in the core of the Midland Basin. You couple that with the strength of its balance sheet, a long-term, investment framework, which in our view should get this stock re-rated. Right. You're seeing a lot of these energy stocks trade at 4 times where, historically they traded at 6 times. So, I think the investment rationale looks very simple in our opinion.